Happy Jobs Report Thursday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Thursday, July 3rd, 2025. It's Jobs Report Thursday, so you know what that means. It's Macro Scouting Report Thursday, my favorite day of the month. But before we get into that, let's get into our executive summary here for this macro minute. We'll start with today's key macro question. Is the labor market still resilient? If you would like to review the analysis supporting these conclusions, obviously you need to be a client of 42 Macro, but most importantly, if you want to see what changes you need to make in your portfolio, if any, to remain on the right side of market risk or to get on the right side of market risk, to the extent you haven't been paying attention to our KISS and Dr. Mo's signals, you need to be a client of 42 Macro. So getting back into the question, is the U.S. labor market still resilient? Our answer, instead of our usual lengthy prose today, we'll simply share the 10 key conclusions investors must know about the current health of the U.S. labor market to remain abreast of the full distribution of probable economic and policy outcomes. Number one, the latest jobs report was supportive of our U-shaped economy thesis. Number two, the U-shaped economy supports our J1 to soft landing theme. Number three, the 42 macro Fab 5 recession signaling indicators currently signal a low probability of a developing recession in the U.S. economy. Number four, historically strong private sector balance sheets are why the U.S. economy keeps experiencing rolling recessions instead of a broad-based NBER-style contraction. Number five, the 42 macro business cycle model continues to assess a low probability of an actual recession in the U.S. economy over the medium-term time horizon. Number six, Wall Street consensus continues to assess a middling probability of an actual recession in the U.S. economy over a medium-term time horizon. Number seven, the May JOLTS report, although stale, was highly supportive of our labor hoarding thesis. Number eight, demographics are a structural headwind for labor supply. Number nine, the change in border policy is another structural headwind for labor supply, with the legal border crossings down 88% year over year in May. And number 10, indeed, labor supply growth has slowed sharply and continues to exert downward pressure upon the unemployment rate. All told, the June jobs report does not materially impact any of our existing fundamental themes. We'll provide a detailed update this afternoon in our July 2025 macro scouting report presentation. So I think this is going to be our best macro scouting report presentation of all time. I mean, there's so much original analysis, so much hard-hitting data-driven content, and this is the tool that we use to keep our thousands of investors across the world, many of whom are institutional. I'd say roughly half of our client base are institutional investors. The other half are retail investors. We use our macro scouting reports to create that full distribution of probable economic and policy outcomes for our clients so that they can have the confidence to execute to dispassionately execute our KISS and Dr. Mo signals, KISS being for retail investors, Dr. Mo being essentially the same thing, but for the institutional investors across 70 factors. They have the confidence to execute those signals whenever the market decides it wants to go from pricing in right tail risk to pricing in left tail risk, or vice versa. They are well aware of what the market may decide to price in when the market decides to price it in. It's not my job to tell the market when to price in right tail risk or left tail risk. It's my job to notice it so that I can reposition my portfolio faster than other investors who are going to be forced to buy after we buy or forced to sell after we sell. That's the 42 macro process in a nutshell. That's how we weave our independent fundamental research process with our independent quantitative risk management process. And this is what the best hedge funds in the world are doing. Many of them are clients. Many of them are listening to me speak right now. We appreciate each and every one of you guys. So transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. Got a couple ones today, so we'll be quick. This one's titled Russell Index versus S&P. It says, hi, DD and team. I've noticed that the recent slide decks have been saying small and mid caps tend to outperform large caps in this current market regime. If that's the case, why not allocate some funds to, say, IWM, which is small caps, instead of only using SPLG for the stock portion of KISS? Is that just for simplicity, as S&P is the benchmark? Obviously, as you said before, we are free to allocate the funds as we wish, but I'm curious from the professional standpoint. I appreciate you. So great question. So this is exactly what our professional clients are doing. Our professional client, when I'm in client meetings all week, instead of executing KISS, which is 60, 30, 10 risk managed stocks, gold, Bitcoin, they have their own mandates. And so they're not just going to sit there and, 60, 30, 10 stocks, gold, Bitcoin because Darius Dell told them to. We're advising on $25+ trillion of institutional client AUM in terms of how much money that those funds manage. And so they have to make all kinds of investment decisions and pivots to outperform their benchmarks or to, stay above their high water marks and generate, consistent positive risk-adjusted returns on a month after month or quarter after quarter basis, depending on what style of fund that they operate. And so this is the kind of conversation I'm having with them because, again, they can't just sit there in the benchmark. They won't get paid. And so the answer is, if you're an institutional investor, it makes some sense to allocate to the types of exposures that you would expect to outperform in a risk on market regime. It's high beta, it's cyclicals, it's small and mid caps, it's growth, it's emerging markets, it's high yield in the credit markets, it's short rates in the fixed income markets, it's commodity currencies and high beta currencies in the currency market. It's industrial commodities instead of energy commodities in the commodities market. There's all these different choices you have to make as an investor, particularly as an institutional investor, to stay on the right side of market risk, to take advantage of what the market is trying to price in the here and now, not necessarily what the market's going to price in 2 years from now, which is what everybody's focused on. If you are an institutional investor, you cannot afford to be worried about 2 years from now. At most, the 99% of the people on the buy side right now can't care about anything beyond 1 year. And so they have to stay on the right side of market risk. And our entire risk management process is designed to help those kind of investors stay on the right side of market risk. And so this is the kind of conversation I would have with them. But if you're a retail investor, why are you making this choice? What's the point? KISS is incredibly effective. I have yet to come across, with my own eyes, a better mousetrap to get retail investors from point A to point B. Point A is stressed out, worrying about their family's financial future. Point B is retiring on time and comfortably, counting money on a boat, sipping rosé in the Mediterranean with their spouse because they retired on time and comfortably. KISS, I can't think of a better mousetrap. I have not seen a better mousetrap. If I saw a better mousetrap, I would figure out a way to build a better mousetrap. But I have not seen it. KISS is the best mousetrap I have seen to get you from point A to point B, and point B is retiring on time and comfortably with as little as stress as possible. I mean, one of the most things I'm most proud of in my lifetime, and boy, I've accomplished a lot in my lifetime, but a lot of that stuff that I've accomplished prior to 42 Macro was about me. It was about me, the accolades that I got in school, on the football field, in other avenues of life that, you know, in the Hamptons and whatnot. That stuff is about me. Enough about me. Now that I'm a dad, now that I'm getting older, now that I'm much more advanced in my faith than I was back then, what I care about now is this, is what what our clients are telling me in terms of how KISS impacts their lives, how KISS is de-stressing them, how KISS is giving them the confidence to remain invested in a raging bull market while everybody else is hiding out in 50 to 100% cash, worried about, you know, Trump derangement syndrome. You know, this is what I care about. This is why we started this company, is because we ultimately knew that retail investors were being underserved, and in some cases, you know, I've seen it with my own eyes, very, very poorly served and quite frankly, taken advantage of across global Wall Street. And, you know, we built this firm to say enough is enough and give retail investors a life raft to get out of what has been a very not great industry for them in terms of delivering them the results that they deserve, that you and your family deserve to retire on time and comfortably. So I encourage you, if you've been kicking the tires on 42 Macro, you know, we appreciate you for kicking the tires. You don't have to become a client. You know, we put out a lot of free alpha on my Twitter account, on my LinkedIn account, and et cetera, in these macro minutes. But I certainly advise you to just scroll down and just review a few of these. Spend 3 to 5 minutes on our testimonials page here. I think you're going to see a lot of people around the world essentially saying exactly what you wish you got from the financial services that you're currently consuming. And it's not because we're trying to make any more money. I don't need another dollar to retire on time and comfortably. But what I do care about and what I do need is to help people. And I can tell by this testimonials page and by inbox, by our client dashboard, the community chat in our client dashboard, that we're having a significant positive impact on our clients. And I can't be more proud of anything in my life to date. So great question. Thank you. But again, just wrapping up, I don't think retail investors need to don't overcomplicate this. KISS is simple. It's 3 ETFs and it keeps you on the right side of market risk with very minimal stress. Why would you try to complicate that by introducing incremental factor risk to your portfolio? Factor investing is the hardest thing to do in finance. Institutional investors get paid millions of dollars, millions of dollars per annum to stay on the right side of factor risk. Why are you trying to do it for free? And this is why I say the same thing about shorting. Like, why are you shorting as a retail investor? You're introducing four-dimension portfolio risk into your portfolio. You don't have time to manage four-dimensional risk. Most retail investors don't have the skill or the time to manage two-dimensional portfolio risk, quite frankly. So why would you introduce shorting or factor risk, two of the hardest things to do successfully on the buy side, where people are getting paid millions of dollars with all their Ivy League degrees to be average at it? So don't complicate investing. Simplify investing. KISS is short for keep it simple and systematic. Keep it simple and systematic if you're a retail investor. And obviously, if you're an institutional investor, I'm having these kind of conversations with you already. So that's easy. That's it. And then finally, wrapping up, I thought this was an important commentary to share in the context of our Paradigm C thesis. So this was titled Equity Mutual Fund Performance Year to Date. It says, I just read an article on Reuters that as of the end of May, 175 out of 279 equity mutual funds were in negative territory. Wow. I'm sure that's improved slightly, but that's a lot of alpha these managers need to make up over the next 6 months. I mean, 42 macro clients, can you tweet me or post at me on LinkedIn? I don't know how to do it on LinkedIn, but tweet at me and tell me, is this not exactly what I've been talking to you guys about for the last 2.5 months? This is Paradigm C. Consensus is focused on the trees, the tariffs, the slowdown in the economy, the congressional brinksmanship. What else are they worried about now? They were worried about Israel, Iran. You know, their consensus is focused on the trees. The forest is Paradigm C. The market understands where we're going. The market understands Paradigm C. The market sees the forest. But these fund managers, 175 out of 279 equity mutual funds were down year to date. Again, I hate the Schadenfreude thing we do in our industry. I'm not here to make fun of any one of these 175 fund managers. I hope they recover and do well for their clients. You know, this is not my concern. My concern is this is just another opportunity to remind investors, you know, what it exactly is that we're doing for our clients here at 42 Macro. Our clients will tell you they're up double digits this year. They'll all tell you, tweet at me, guys. If help me out here, you know, back me up on this. You know, and so I just want you to understand that, look, there's a different way to invest than what everyone else is out there doing. Everyone else is out there doing, like, I did some research and I'm going to put a position on. I did some research and now I'm going to take a position off. That's fine. That's what most people are doing. But I tell you right now, I've been in my 17th year of servicing institutional investors across global Wall Street. None of the best funds that you all read about on the paper and see on TV do that. None of them. Zero of them. Zero. So we built our entire research and risk management process around what those funds are doing, not what this 175 funds are doing. No offense to any one of them 175, but it's very clear they're not in the top decile fund manager on global Wall Street. And that's okay. You know, it's an opportunity for them to improve and increase improve their process and deliver better results for their clients. And I hope that they do that. Again, this is not a Schadenfreude show. I hope everyone does well in life. But I do think it's a reminder that Paradigm C is not priced in, because these guys and everyone that's investing like them, that's not investing like we do at 42 Macro with systematic signals like KISS and Dr. Mo, everyone that's investing like them needs to capitulate to the upside in the coming quarters. And in our view, Paradigm C is nowhere near priced in. So giddy up. Have a great weekend. Everyone enjoy the long holiday. We'll catch you back here on Monday. Cheers.